Hello accounting students. Today's video is all about Chapter 10, and Chapter 10 is all about Stockholders Equity. So we have lots and lots of learning objectives in this chapter. Feel free to pause this and read through them if you want, but I'm going to just keep going forward so we can talk about all of these interesting things about corporations. All right, so recall from way back at the beginning of our course, we talked about the advantages and disadvantages of different types of organizations. So very quickly, I just want to review. Remember that corporations have limited liability, which means that if you're a stockholder in a corporation, you cannot be held liable for the debts of the corporation. And also the ability to raise capital and transfer ownership, because if you have shares, it's easy to sell shares to a number of people and also to transfer those shares to someone else. The disadvantages of corporations are double taxation, which means that, remember, a corporation files its own tax return and has to pay its own taxes. And then when the corporation distributes its profits, which it has already paid taxes on, those distributions, remember we call dividends, those get taxed to the stockholders. So that is the double taxation. And also, it does take quite a bit of paperwork to form a corporation. All right, so when a corporation issues stock, there's a bunch of different terms that we have associated with the stock. So the authorized number of shares, so here we're talking about authorized shares. The authorized number of shares is the largest number, and that includes all of these. So the authorized shares are the total number of shares that the corporation is allowed to issue per its charter. So of those authorized shares, they can be either unissued, which means they're still sitting there, they have not been sold to stockholders yet, or they can be issued. And issued means they have been sold to stockholders at some point. Now the shares that are outstanding are the ones that are still in the hands of stockholders. So they've been sold to stockholders and the stockholders still have them. Treasury stock is shares that have been bought back by the company. So these are shares that were issued to stockholders and then they were repurchased and the company is holding them. So remember later when we look at dividends, of course we're not going to pay dividends on treasury stock because those are shares that the company is holding itself. So that would just be paying itself, right? So when the company pays dividends, it pays dividends on outstanding stock. So remember that for later. Okay, so the largest number is authorized, the next largest number is issued, and then outstanding is the smallest number. All right, so when we record the issuance of stock, so the first time stock is sold, there are two different ways to record it depending if the stock has a par value or a stated value or has no value associated with it. So the par value is sometimes called the legal capital. The par value is just an arbitrary amount, has nothing to do with market value. The par value is the amount that common stock would be credited for when you issue the stock. And stated value works the same way. So if you have par value or stated value, when you issue shares, that's the amount of your credit to common stock. If you have true no par, the entire issuance price is credited right to the common stock account. So let's see how that works. Let's say that a company issues 10,000 shares of $1 par value stock for $25 each. All right, so this is what our journal entry looks like. We're issuing 10,000 shares at $25, so we're getting cash of $250,000. We're crediting common stock, remember I said for the par value. So the par value is $1 per share, so we're crediting common stock for $10,000. And the additional paid in capital is $240,000. All right, so by way of reminder, the issuance price is what's debited to the cash. The par value is credited to common stock. And the amount over par, so in this case it would be $24 per share, is credited to additional paid in capital. This works exactly the same if the company had a stated value instead of a par value. You would just use the stated value here instead of par. Now, what happens if the company has no par? Or if the stock has no par and the company issues the same shares for $25 each, Remember, the whole thing goes right into common stock. Oh, this is a mistake. Don't look at that. All right, so the cash goes into the whole cash is debited to 250,000, and then the common stock is credited for 250,000. All right, there should be 25. Okay, so the whole issuance price. All right, next up is preferred stock. So preferred stock is just a different kind of stock, and it's different in a few ways. Generally, it has no voting rights, and it's less risky than common stock because preferred stockholders get paid their dividends and distribution of assets if the company should liquidate before common stockholders. So preferred stockholders are kind of in the middle of the list of distribution if the company goes under. Creditors are first, then preferred stockholders, then common stockholders. And recording the issuance of preferred stock is the same as common stock, only instead of crediting common stock, you would credit preferred stock. Now, preferred stock dividends are often expressed as a percentage. And so you might see something like this, 5% $100 par value stock, and that means it pays $100 times 5% or $5 per year. That's the dividend on that stock is $5 per year. You might also see just $5 $100 par value, and that just means that the $5 is the annual dividend. Cumulative versus non-cumulative is important because cumulative preferred stock means that if they don't get paid their dividends in 1 year, those dividends get saved up and have to be paid before the preferred stockholders can get paid in future years. And non-cumulative just means if the dividends don't get paid, it doesn't matter. They just go away. Okay. So next up is Treasury Stock. So Treasury Stock, remember I told you before, is the corporation's own stock that has been bought back again. And the purchase of Treasury Stock is recorded at the cost of the shares purchased. So don't forget that because we ignore the par value, we record it at cost. So let's see how that works. Let's say a company purchases 100 shares of its $1 par value stock for $5 per share. So it's buying its stock for $5. It debits Treasury Stock for the cost of the shares, like I said, $500, credit cash because they're paying to buy these shares for $500. The Treasury Stock account sometimes feels like an asset, but be careful, it is not an asset. It is a contra stockholders equity account. It goes against stockholders equity. It's subtracted at the bottom that we'll see later, okay? So Treasury Stock is a contra stockholders equity account. All right, now if the company resells its shares, let's say it resells half of them at $6 a share, this kind of looks like an issuance of stock, right? You debit cash for the purchase price, for the selling price in this case, $50 times 6, which is $300. Credit Treasury Stock for the cost. This is the original cost because remember, let's go back a minute. These shares cost us $5 a share. So you credit it for cost and then additional paid in capital gets credited for the balance. All right, so remember that retained earnings includes all of the net income the company has earned since it started in business, minus all of the dividends it's paid since it's been in business, right? And retained earnings is what we use to pay dividends. So dividends, remember, are distributions by the corporation to its stockholders. Dividends can be cash, you can pay them cash, stock, or property. So cash is, of course, the most common, followed by stock. Property, of course, if you have a lot of stockholders, property has to be divisible in order to give it out to your stockholders. So we're going to look at cash and stock here. Remember that dividends are not required to be paid by a corporation. This is the corporation's decision. But legally, they're not required to pay the dividend until it's declared, which we'll see in a minute. All right, so declaration is the date. There are 3 different dates when it comes to dividends. The declaration date is the date when the board of directors says we are going to pay a dividend. When the board of directors says that, the company is legally liable to pay the dividend. Remember, I said they're never required to, but once they declare the dividend, they have a liability. The record date is the date that, remember, shares are changing hands every day, right? So in a big public corporation, shares change hands every day. So the record date is if you own stock on this date, you get the dividend. Okay? And then finally, the payment date is simply the date that the dividends are actually paid to the stockholders. All right, so let's see how this looks in the form of journal entries. So on January 1st, the company declares a 10 cent per share dividend on its 20,000 outstanding shares to stockholders of record on February 1st to be paid on March 1st. So January 1st is our declaration date, February 1st is our date of record, and March 1st is our payment date. So remember I said on the declaration date we have a liability. So we're going to debit dividends. I'm sorry, this is wrong, but just pretend it's right because just because. Okay, I'm just going to go ahead and go with this. All right, so the company, let's just pretend this is the right number here. This should be, of course, $2,000, but that's right. So the idea is that you use the number of outstanding shares. So we're going to debit dividends. This is going to come out of retained earnings eventually. We're going to credit dividends payable. So the dividends payable is a current liability, of course. And remember we said that on the declaration date, we have a liability. All right. On the record date, there's no journal entry because that's simply the date that the company says, okay, whoever owns stock today, these are the people that are getting paid the dividend. And then finally, on March 1st, that's the payment date. And this is just the same as paying any other liability, right? You debit the liability and you credit cash. All right, so debit the dividends payable and credit cash. All right, so let's talk about stock dividends and stock splits. So a stock dividend as opposed to a cash dividend, which is what we just looked at. Stock dividend is additional shares that are issued to the current stockholders. And they come out of retained earnings just like a cash dividend. So if you have 100 shares of stock and the company issues a 10% stock dividend, then you're going to get 10 more shares. And everybody is going to get 10% of what they owned before the stock dividend was declared. It comes out of retained earnings just like a cash dividend. Now a stock split is a little different. A stock split is also a case where additional shares are issued to the current stockholders, but in that case, there is no journal entry. Some of you are cheering. There's no journal entry. And basically what the company does is it decreases the par value per share of stock proportionately to the number of shares that are issued. All right, so let's see how these work. All right, so a stock split. Let's say that the company has 100,000 shares of $10 par value stock outstanding. So before the split, they have 100,000 times 10. They have $1 million worth of stock outstanding. Now, they have a 2-for-1 split. So that means if you have one share, now you have two shares. So they issue another 100,000 shares, and the par value is cut in half because it's 2-for-1. All right, so proportionately. So now, after the split, they have 200,000 shares, and the par value has been reduced to $5, but notice that the total amount of stock is still $1 million on the balance sheet. So a stock split does not affect the balance sheet other than to change the number of shares and the par value per share. Now, it does have an effect on market value, of course, because when the shares are doubled, the market value goes in half, and then generally it bounces back up again. All right? Okay. So let's see. This is a reminder of the statement of stockholders' equity. And when we had the statement of stockholders' equity before, we only saw common stock and retained earnings. So now our statement of stockholders' equity has additional paid-in capital, and it also has treasury stock. Okay, so let's look at just how this works, right? So remember, let's look at what affects each column. So the balances are at the beginning, that's fine. We issue common stock. So when they issued common stock, your common stock account went up, but also additional paid-in capital went up because they sold the shares for $4,030,000. Okay? We don't know what the par value of the shares are here, so but maybe it was $1 and they sold the shares for $4,030,000. Okay? All right, then they buy back some treasury stock. So when they buy back treasury stock, remember that's a negative. Remember I said treasury stock is a contra stockholders equity. That's a negative amount in your stockholders equity. So that's reducing your stockholders equity. And it's here in the treasury stock column. When they declare dividends, remember dividends affect retained earnings. Remember dividends come out of retained earnings. So that is a negative in our retained earnings column. And this column over here is easy. Don't forget, everything just gets added across over here. All right. So once you put these numbers in here, this part is easy. You're just going to make sure everything goes across, right? So this negative is here. This negative 318,000 is over there. Now we're going to resell some of the treasury stock. So it looks like they resold 195,000 at cost, right? But they sold it for a little extra. They sold it for $210,000. So they got some $15,000 in additional paid-in capital. So that's an increase to stockholders' equity. And then finally they had net income, and remember net income goes into retained earnings. So when all is said and done, you can add these columns. We call this cross-footing and cross-footing. So you add all of these down and you add across, and then you make sure that they're equal. All right? And all of the stockholders' equity transactions for the year are reported in this statement that is included in the company's annual report. Now, on your balance sheet, you have your stockholders' equity section. So this is kind of abbreviated because you would have some more details in your stockholders' equity section. But our stockholders' equity is broken up into two sections, paid-in capital, and that's the money that has been paid in by stockholders. And then you have your retained earnings, right? And at the bottom, we take out any treasury stock. So preferred stock is always listed first because remember, preferred stock gets paid first. And so our preferred stock is listed first. Our common stock is listed after that. Then our additional paid-in capital. And then finally our retained earnings. And at the very bottom, after you have all your paid-in capital and retained earnings, we subtract out the treasury stock. Sometimes you'll see a subtotal before this, so total paid-in capital and retained earnings, but you're going to get the same balance, right? It's these three numbers added, and then you have your total stockholders' equity. And this, of course, would get added to your total liabilities, which would be above it, and then you would have your total liabilities and stockholders' equity on your balance sheet. All right, so we looked at this already. Let's take a look at a couple of dividends. We're going to look at, okay, so we're going to take a look at 4 ratios very quickly because I know this is quite a long video. And the 4 ratios are ratios that we use that have to do with stockholders' equity and evaluating companies. So the first one is return on equity, and that is net income divided by your average stockholders' equity. Now, if you're calculating this, don't forget your average stockholders' equity is your beginning plus ending divided by 2, okay? And this tells you how well did the company use the stockholders' equity resources you gained from stockholders' equity in order to generate net income. Generally speaking, higher is better. All right, dividend yield. Dividend yield is how much dividends per share does the company pay divided by its stock price. So this is kind of like, if you think about it, like you could compare it to an interest rate, right? Because an interest rate would be like how much interest are you going to get compared to how much you have to invest. So basically it shows the amount of dividends the company pays compared to its stock price. So you could compare it to other investments. Earnings per share is used quite a bit. And if you're studying accounting, you will learn that earnings per share is actually quite complicated. You're going to study a whole chapter of it later on. But for now, earnings per share is net income minus preferred dividends divided by the average number of common shares outstanding. So we know what net income is. This is the total preferred dividends. And the average number of common shares outstanding is, again, beginning plus ending divided by 2. So how many shares were outstanding at the beginning? At the end, divide by 2. And that shows us how much income the company earned for each share of common stock. A very carefully watched metric. And of course, higher is better. All right, and then finally we have the PE ratio, or the price earnings ratio, and that shows how well the stock is trading, what the stock price is compared to its current earnings. So it's the stock price per share divided by the earnings per share. All right, so that's all we have. I know it was a long video. There's a lot of stuff in this chapter, so make sure you take the time to go back and review this and go through the guided notes. And I'll see you next time.